As of today, March 23rd, Sirius, the COMEX silver delivery system is under stress it was never designed to handle. 4 days ago, the CME's own house account absorbed 82% of that day's entire silver delivery flow, 114 out of 138 delivery notices, 570,000 ounces of physical silver, stopped by the exchange itself because the shorts could not deliver. The referee became the buyer of last resort, and today, right now, the registered inventory sitting behind all of these paper contracts is still draining. The stress has not eased. The gap between paper price and physical reality has not closed. If anything, it has widened. Pause. This video is the complete picture of where the COMEX silver system stands today. Stay in. To understand why March 19th mattered, you need to see the 5 months that led to it. November 2025, 30 million ounces stood for delivery, already elevated compared to historical norms. December 2025, 65 million ounces delivered, an all-time record month. Over 60% of registered inventory was called in just the first 4 trading days of that window. January 2026, 49.4 million ounces delivered, more than 7 times the prior January average, 7 times. February 2026, 33.5 million ounces delivered, the highest February on record. March 2026, through March 19th alone, 43.4 million ounces already delivered with days still remaining in the window. Added up, over 221 million ounces of silver have stood for physical delivery and left the COMEX system in just 5 months. That is not normal delivery activity. That is a run on physical supply. And the registered inventory backstopping all of it is currently sitting at approximately 78 to 80 million ounces. 221 million ounces demanded in 5 months. 78 to 80 million ounces left to deliver against. When the math looks like that, the house account absorbing 82% of 1 day's notices is not a surprise. It is the inevitable outcome. Here is why the 82% figure matters so much. COMEX futures are supposed to work like this. A short seller agrees to deliver physical silver at a set price. When a contract holder demands delivery, the short seller provides the metal. When 82% of contract holders on a single day cannot get metal from the short sellers, and the exchange itself has to step in, it means the shorts could not find physical silver to deliver at current prices. The price on your screen said one thing. The physical market said something completely different. That gap between paper price and physical reality is exactly what the 82% house account absorption is measuring. And it is not just happening at COMEX. Look at what happened in China. China's only pure-play silver futures fund, the UBS SDIC Silver Futures Fund LOF, was suspended for an entire trading day on January 30th, 2026. It was the second full-day suspension since January 22nd. The fund was trading at a premium of approximately 36% over its net asset value, 36% above NAV. Chinese investors were so desperate for silver exposure, they were paying 36% above the certified value of the underlying metal just to get access to the fund. The Shenzhen Stock Exchange had to step in. The fund manager issued multiple risk warnings before the halt. When China's only silver futures fund has to halt trading twice in 8 days, because demand is so intense it is creating systemic risk, that is the physical reality of the silver market expressing itself, not through the paper price, through behavior. The structural backdrop makes all of this make sense. The Silver Institute has confirmed 2026 will be the 6th consecutive year of structural supply deficit. COMEX registered silver inventory has fallen from 240 million ounces in April 2020 to approximately 86 million ounces by February 2026, a 64% decline over 6 years. China implemented strict export controls on refined silver on January 1, 2026, severing traditional arbitrage routes and creating a persistent premium of $8 to $13 per ounce on the Shanghai Gold Exchange compared to New York prices. Solar panel manufacturing alone consumed over 140 million ounces of silver in 2025. Electric vehicles, 5G infrastructure, AI data centers, defense systems. Every one of these sectors is consuming silver faster than mines can produce it. The 6th consecutive deficit year is not a projection, it is the documented mathematical result of that demand meeting constrained supply. The bear case deserves direct acknowledgement. COMEX has managed delivery pressure before. The house account absorbing deliveries is unusual but not unprecedented. It functions as a circuit breaker, not necessarily a death spiral. The exchange has tools it has used before: higher margin requirements, delivery mechanics changes. In extreme scenarios, force majeure cash settlement at a price of the exchange's choosing. The Hunt brothers found this out in 1980 when COMEX went to liquidation-only mode. While the exchange has managed to avoid a formal default thus far through aggressive margin hikes and the introduction of cash-settled alternatives, the underlying physical shortage cannot be solved by financial engineering alone. If economic conditions deteriorate significantly, industrial silver demand could weaken. Silver is approximately 50% industrial metal. A meaningful slowdown in solar, EV, or electronics manufacturing could ease physical delivery pressure, and paper price suppression can continue as long as enough participants accept cash settlement. Most futures traders never intend to take delivery. As long as that remains true, the paper market can continue setting prices. Know the tools the exchange has. The system can be managed for longer than the delivery math suggests it should be. Here is what to watch over the coming sessions. Watch the daily COMEX delivery reports. The CME publishes these publicly every trading day. If the house account continues absorbing a significant percentage of daily delivery notices, the stress is not easing. If commercial short sellers start delivering metal again without house account support, the acute pressure is temporarily relieving. Watch COMEX registered inventory, approaching the danger zone below 80 million ounces. At current delivery rates, that is roughly 2 months of cover. If inventory drops below 70 million ounces, we are in uncharted territory. Watch the Shanghai premium. The persistent premium of $8 to $13 per ounce on the Shanghai Gold Exchange compared to New York prices confirms Asian physical demand remains structurally stronger than Western paper pricing reflects. If that premium widens further, physical tightness is deepening. If it narrows significantly, physical supply is finding the market. Watch May COMEX open interest. May is the next active delivery month. If open interest concentration in May contracts builds significantly, sequential delivery pressure from March could transfer directly into May, creating a cascading stress scenario. Watch for any CME rule changes. When exchanges are under stress, they change the rules. Any announcement regarding margin adjustments, delivery procedure changes, or position limit modifications is itself a signal that the stress is becoming harder to manage quietly. Watch Chinese market developments. The UBS SDIC Silver Fund suspension pattern is a real-time demand signal. If additional Chinese funds halt trading or issue extreme premium warnings, physical demand in the world's largest silver-consuming nation is overwhelming available supply channels. Here is where the silver market stands as of March 23rd. The CME house account absorbed 82% of delivery notices on March 19th. 221 million ounces have left COMEX in 5 months. Registered inventory sits at approximately 78 to 80 million ounces. China's only silver futures fund halted trading twice in 8 days due to 36% premium over NAVI. The Silver Institute confirmed the 6th consecutive year of structural deficit. China's export restrictions have severed the traditional arbitrage route between East and West. None of those facts changed because the paper price is at $70 or $65 or wherever it sits when you watch this. The physical market is telling a very specific story. The paper market is telling a different one. One of them is right. Watch the house account absorption percentage daily. Watch registered inventory against the 70 million ounce danger threshold. Watch the Shanghai premium direction. Watch May open interest building. Every one of those data points is publicly available. Every one of them tells you which story is closer to the physical truth. Verify everything in this video using the sources listed below. Invest with logic, not hype. Market Crux, signing off.